folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. It is relatively quiet post-election. We're here in the last couple of days leading up to Thanksgiving, and not a ton going on out there. S&P 500 right at about 59.44 as I'm speaking. That's up about 25.3% year to date. And it's really kind of been range bound between about 6,000 at the top end and maybe the mid 5,800s, 5,900 around that range for the past month, really. Saw a little bit of a dip around the election, saw a little bit of peak on the other side of it, and now we've kind of drifted down a little bit. Really kind of a continuation of this sort of Goldilocks, not too hot, not too cold narrative, that exists in the marketplace. We saw a jobless claims report that was interesting this morning in terms of the number of jobless claims actually dropping to a 2-month low as employers, I think, created a lot of new jobs after the sort of storm-related incidents in October. But then, flipping the coin on that, we saw continuing claims at a high since sort of 2021, indicating that once people do become unemployed, that it's taking them a little bit longer to find a job. That is actually, from the Fed's standpoint, okay. We don't want too terribly strong of a labor market as we think about inflation. And would just note that, the rest of the economy appears to be doing incredibly well. That inflation number still stays, right around that 0.2, 0.3% month over month number that the Fed is looking for. We continue to see earnings come through for the S&P 500 at a relatively robust level. So with about 473 companies reporting for the S&P 500 for Q3. We've seen net income numbers up about 8% and revenue numbers up about 5%, which are both ahead of sort of 4% estimates. And that's all good. The thing that it may do is give the Fed a little bit of pause around continuing the path of rate declines. The forward curve, if you will, that sort of predicts what the Fed is going to do next, actually now shows less than a 50% chance that we get another rate cut this year at the December meeting. Most people thinking that the Fed will actually leave interest rates where they are for the rest of 2024 and then kind of roll into 2025, which sort of brings me to an interesting point, which is the 10-year Treasury is still hanging out about 4.4%. Which is, not that far off the highs. In this interest rate cycle, the 10-year Treasury peaked at 5%. We certainly saw a dip earlier this year as it became clear that the Fed wasn't going to be raising rates any further. But as, the sort of narrative around the Fed has materialized that, they're not going to be raising rates anytime soon, but the path of cutting rates also is likely to be very, very slow. The 10-year Treasury has sort of responded by rallying a little bit on the long end of the curve. And certainly with an upcoming change in administration that seems to be, more favorable for higher yields, not lower, the Treasury market certainly demonstrating a little bit of resilience out there on the long end of the curve. So something to keep in mind, that we keep in mind as we think about allocating fixed income portfolios. With that, I bring to the last but not least thing that I would like to say, which is it is a season of Thanksgiving. And I certainly, one of the biggest things that I am thankful for is all of you. We wouldn't be here, we wouldn't get to be able to do this fun job without you guys. I certainly appreciate you guys tuning in to these market updates, and I know our advisors appreciate your business. So I hope with that you have a wonderful holiday season. And as always, if you have any questions, please feel free to reach out to myself or to your advisor. Happy holidays.